Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to talk to you about 8 ideas that you might hear from your CPA that could be really bad tax planning. So these are just concepts that I hear marketed over and over by CPAs as good tax planning, but in a lot of cases, it's the exact opposite of what you should be doing. Before I dive into those concepts, I want to start with a real life story of why this is so important to me and why I think it matters that you never just rely on the advice of someone else for things that are important to you. So my wife has a neurological disorder. She is prone to have seizures. So, frequently we have to visit different neurologists to manage her medicine and to, hear about updates and treatment options that might be available to her. Many years ago, we were seeing this neurologist and I asked him about seizure tracking bands that you can wear. So it's just like my Garmin watch. It would be something that she could wear. And if she ever had a seizure, it would alert me and tell me where she is. So you could imagine why someone who lives in New York City and has someone important to them that is prone to have seizures might want to know about or, have some sort of tracker like that. So this guy had no clue what I was talking about. He specializes and focuses his entire career on epilepsy and treating patients that have seizures, and he had never heard of these trackers. It wasn't like they were brand new. They had been around for a while. I just was wanting to get his advice on which ones his patients liked and didn't like, and he just didn't have a clue. So I don't know why this guy wasn't keeping up with updates. I think it's very important, that someone who treats epilepsy should be focusing on that and, taking care of their patients. That's a very serious disorder in a lot of cases. So I was, needless to say, we didn't use him after that. But I was shocked. That was a big eye-opening experience to me that people that are working on things that are so important aren't keeping updated, on developments out there and things that can help their clients. If you think that's true in the medical industry, I can guarantee you that that's true in the accounting industry. It's true in the tax industry. It's true in the finance industry. People are not always staying up to date. People just kind of get complacent and they just recycle the same information. How many times have you listened to a podcast where a CPA just says, get an S Corp, and then just spits out this same little low-hanging fruit tax planning that everybody should already be doing anyway and is only really going to save you a couple $1,000s a year? So this is really important. I know I joke a lot about, you can't rely on, your advisors for anything that's important, but it is really serious. We have to take this seriously. If you want to get serious about building wealth, achieving financial freedom, you're going to have to take the reins. You cannot just rely on the advice of somebody else. So that's my spiel about why this is so important. And I hope you will, start to think about, and if you're watching this video, you're already taking the first step in learning about these concepts yourself instead of just going to some provider, paying them a couple $1,000s and saying, tell me what I need. So kudos to you for, taking that initiative yourself. So let's just run through these really quickly. I don't think there's anything too complicated here, and chances are this might be, just a reminder for a lot of you. Number one, I hate 401ks and traditional IRAs. Those are really meant for people who need financial responsibility. So if that's you, no one's judging you. We all have our vices. And so if you're someone who's, really worried about, can I trust myself to save enough money for retirement? Then yeah, you probably do need to think about something like a 401k or IRA. But for those of us who are trying to build wealth, I cannot stress enough, you do not want to build wealth inside a 401k or a traditional IRA. Yes, we like Roth IRAs. I talk a lot about them, but traditional retirement plans where you don't pay tax now and you pay tax in the future when you start taking distributions. I hate those plans. If you are someone who, already is wealthy or will be wealthy, you can get yourself in a big, big trouble from a tax standpoint by having big accumulations inside those plans. So I'll link below to my video on the ticking tax time bomb that's coming with, these 401ks and IRAs because of the required minimum distributions. But you have to take this seriously. You do not, I'll say this a million times, you do not want to build significant sums of wealth inside a 401k or traditional IRA. So I could talk about that and rant about that all day. But if your CPA is recommending that, and I honestly, most of them do, I think most of the really good ones are switching that. I think most people know at this point that that's not a good idea. And we're seeing the mistakes that were made, by like our parents' generation from that. But if your CPA is still recommending that, you got to really think about if that's the right person that you should be listening to. The same thing, this is even more egregious. So, and that's why I put the big red flag. So if your CPA ever recommends to increase your salary solely to make, max out or make retirement plan contributions, I think that is malpractice. I think under current tax laws, with the where rates are and the different tax benefits available, I think that could be considered malpractice. So, if that's your CPA, you got to just get a new CPA, because that's beyond just bad tax planning. Salary income is the single worst type of income you can ever earn. So if you're increasing the salary, like if you're a business owner, this usually is where that it's going to come up. Of course, if you're a W-2 employee, you want your salary to be as high as possible because you're just making more money. But if you're a business owner and your CPA is saying, bump up your salary so that you can make retirement plan contributions, that is a big no-no, and it just makes no sense whatsoever. 3 and 4, I hear this all the time. Again, you go to this podcast where CPAs are talking about year-end tax planning, and I hear that this is really crazy. That's why I have the eye roll and the face palm, because it just blows my mind. So prepaying your expenses before year end, you're trying to, increase your tax deductions in this year and defer, that to the next year's where you're going to pay more tax, or defer revenue. So you're trying to kick out revenue to a future year. So you're decreasing current year taxable income because you're going to reduce the top line, the income coming in. Those are just really bad strategies from both a business and an investment standpoint. If you're a business owner, if you're an investor, cash is king, right? So we understand that we want that money now. We want that money to reinvest back into our business, to, make investments with, if we're taking the money out of the business and investing in something else. So the idea that I want to decrease my profits just, to try to do what they're calling tax planning, but it's really not tax planning. You're just shifting the tax burden down the line, actually, which is bad because tax rates are just going to go up, in the future. So that is just really bad. You need to understand that. That is just, kicking the issue down the road. And that's not tax planning, right? Not at all, not even close. So watch out. That's just something that just keeps getting recycled and recycled over and over. Number 5, I've started to hear this, and I think it's become even more dangerous in current, with the current real estate market. So CPAs sometimes can get siloed and they're just focused on the tax savings. They're not thinking about the broader business issues, investment issues, financial issues, asset protection, whatever it is. They're not thinking about that. They're thinking about, how can I lower your tax bill? Well, you might do something on the tax side, but then you might be making less money because it's just a bad investment. And I think that's the perfect example with number 5 is CPAs might recommend, if you're renting office space, in a multi-use building, they may say, why don't you buy the building, lease it out to the other tenant so you get the depreciation deductions. Yeah, you might get depreciation deductions, but who wants to own commercial real estate right now, especially if, the tenants are businesses? Nobody's doing that, right? So that's a really bad investment. So while you may or may not save taxes, depending on how that shakes out, that's just a really, really dumb investment. You could not, pay me to invest in commercial real estate right now. It just doesn't make any sense. This is not the time. So that's a good example of, you're looking at solely tax benefits and you're ignoring the fact that it's just a really bad business decision or investment decision. So be careful with those types of things. That can apply beyond just office buildings. So, if you're thinking about, if your CPA is saying, make this business decision because it'll save you taxes, is that a smart business decision? Is it a smart investment decision? Don't just think about the tax impact, because there's a much broader, range of things at play here. Number 6, I think this could also borderline on malpractice as well, but I hear sometimes, usually this is very rare, but sometimes you'll hear CPAs talk about owning real estate through a 401k or IRA. That is just makes absolutely no sense. So the reason you invest in real estate is because it is the best investment from a tax standpoint. The tax benefits you get from real estate investing just cannot be matched by other asset classes for the most part. So why are you owning those in a tax-free account like a 401k or IRA? That just absolutely makes no sense. There's a lot of other issues with that. Usually the only time I see this recommended is by people or CPAs or CPA firms that set up and do like 401k administration. So they're getting, some sort of financial incentive to you putting more and more assets in there, just setting them up through them. So watch out for that. That's a big no-no. It makes no sense. If you do have money inside a 401k or IRA, there are much better assets to put in there than something like real estate, which you want to own in a way that you get the direct tax benefits. Number 7 is I don't hear this talked about as much, but this is kind of, similar to the maxing out the use of like 401ks and traditional IRAs. So I hear a lot of CPAs still, talk about maxing out 529 plan contributions. So, we know 529 plans are ways we can set up, and get some tax benefits by putting money in there to save for our kids, schooling, college tuition in the future. They're really meant to, get parents saving now so their kids can go to college. So I'm assuming if you're watching this video, you want to understand how to build wealth. That's what I do. I'm not here to teach financial responsibility. That is more for Dave Ramsey. I'll leave that to him. But if you are trying to build wealth, you do not want to be making 529 plan contributions, usually early, when your kid's young, trying to save up that money and build up that nest egg. There's a number of reasons. I'll do some videos on that in the future. But 529 plans are not great. The things you can invest in are usually quite limited. You lose a lot of flexibility within those plans, and you also have fees, and those usually by far outweigh the small tax benefits that you are getting. So the way to use 529 plans, I think of is a wash scenario. So you want to kind of put it in and take it out really quickly. You want to be careful about accumulating large balances. So if your kid's 3, I don't know that it usually makes sense. Again, assuming it's not a responsibility standpoint, assuming you're not, unable to trust yourself to save for your kid's college and pay for your kid's college. I'm talking about if you're just using this for a tax benefit, it usually doesn't work out that it makes a lot of sense to just start really early, and keep saving that money inside that plan, because it's just really inefficient once it's in there. So the last thing I want to mention is that, when CPAs talk a lot about tax planning, they talk a lot about like low-hanging fruit tax strategies. So what are these? So these are, don't get me wrong, these are great tax strategies. Usually they're really only available for business owners, but things like, an S corporation structure for your business, things like, the home office deduction for people who work from home and have some sort of business or side hustle, things like that. Those are great strategies. Yes, you should do them, but what you should not do is waste a lot of time on them. So that's why I have, the time and the clock inside a trash can, because the last thing you want to do is to focus a lot of your time and efforts around this low-hanging fruit tax planning. Watch my videos, take my business strategies course. I'll link to that below. That is all the business strategies, if you're a business owner, that you should think about using, in my opinion. I discuss all the tax planning strategies. They're very basic. The course is really cheap. I wanted specifically to make the course cheap to, people who are just getting started in their businesses, especially, women and minority-owned businesses that might not have the same opportunities as everyone. So I do want to make sure that course is accessible to everyone. So that's why I made the price point very low. But I'm not saying don't do low-hanging tax fruit. I'm saying, yes, do it. Check out my course, tell your CPA I'm doing this, document it, bam, move on. That is not tax planning. Saving a couple $1,000s a year, while that's great, I'm all for it. I do everything I can to save every penny of tax. I hate paying taxes, doing legal strategies to avoid taxes. And so do those absolutely, but do not view that as tax planning. You need to be spending your time on real tax planning that's really going to move the needle for you. That is buy, borrow, die. That is, real estate investing, whether it's passively or actively. That is starting a side hustle. If you're someone who doesn't own a business, that is making sure you invest your money in ways that you're never going to pay tax or you're going to pay little tax on those earnings that money makes. So those are real tax strategies. Those are tax strategies that, are going to save you millions of dollars if you're someone who's going to be wealthy. Those are not tax strategies. We don't want to waste a lot of time focusing on tax strategies that aren't going to significantly move the needle as far as building wealth for us. So I want to be clear with number 8 that the stuff your CPA markets to you as tax planning is usually going to be low-hanging fruit that you could just do yourself. If you take my course, I give you a lot of the templates and materials and things that can help you do that. But also, don't ever pay a CPA several $1,000s to tell you about these things. This is stuff that you should already be doing if you're a business owner, and things that, you can easily put in place. So these are just 8, really bad ideas that I hear CPAs market over and over as tax planning. What I want to stress to you is that you need to be focusing on real tax planning strategies. And these are strategies where you can make millions and millions of dollars without paying tax or paying little to no tax. These are the strategies used by the wealthiest people in the country. These are this type of strategies that are going to help you get to financial freedom early in life. They're going to help you build wealth efficiently, and they're not going to be a waste of your time. So if you want to learn more about those great strategies, make sure you subscribe to my channel and check out my future videos.